If you ask the average person what SpaceX is, they'll tell you it's an aerospace company. And honestly, who could blame them? For over 20 years, SpaceX earned its legendary status the hard way. They normalized landing orbital-class rocket boosters on autonomous drone ships. They built Starlink into a global internet powerhouse, and they single-handedly brought the cost of space launch down by 85%. For anyone who loves physics and engineering, SpaceX has been the undisputed gold standard. But on June 12, 2026, SpaceX pulled off the biggest corporate magic trick in modern history. The company went public on the NASDAQ under the ticker SPCX. It was the largest IPO ever, raising $75 billion and instantly valuing the company at a mind-boggling $1.77 trillion. But if you look past the hyperventilating news headlines and open up the official S-1 prospectus filed with the SEC, you discover a reality that completely flips the script. SpaceX did not file as an aerospace corporation. They legally registered under industry code 7370, the exact classification reserved for computer programming and data processing. In plain financial terms, SpaceX just told the world that it is no longer a rocket company. It is an artificial intelligence data center startup hidden inside a cosmic Trojan horse. To understand how we got here, we have to look at the total addressable market, or TAM, that SpaceX presented to institutional investors. They claimed a jaw-dropping market opportunity of $28.5 trillion. That is roughly equivalent to the entire annual GDP of the United States. But the real shocker is buried on page 11 of the prospectus. Out of that massive $28 trillion pie, only 15% is allocated to rockets, space exploration, and satellite internet. The other 85%, the prospectus explicitly defines it as enterprise large language models and cloud data center operations. For years, staying private allowed SpaceX to focus on multi-decade engineering goals instead of being forced to obsess over short-term quarterly earnings. And the core business was incredibly healthy. By 2024, the rocket division alone was genuinely profitable, pulling in $791 million in net income. By 2025, Starlink was an absolute cash cow, generating $11.4 billion in revenue and over $4.4 billion in operating profit. It was a highly successful, cash-generating monopoly. Then came February 2026, and everything changed. SpaceX executed a sudden, massive all-stock merger with xAI, the artificial intelligence startup behind the Grok chatbot. The moment those two companies became one, the pristine financials of the world's greatest rocket company were completely upended. Because public markets require retrospective accounting, SpaceX had to combine its books with xAI for the previous year. The results were devastating. Even though Starlink and the rocket divisions brought in a record-breaking $18 billion in 2025, the newly merged company was forced to post an annual net loss of roughly $5 billion. Why? Because xAI was burning through capital like an absolute furnace. The AI division was spending $2 for every single dollar it earned, leading to a terrifying daily cash burn of about $28 million. By the first quarter of 2026, things accelerated. Capital expenditure for the AI wing hit $7.7 billion in just 3 months. That put the company on an annualized burn rate of over $30 billion. Suddenly, SpaceX's capital expenditure skyrocketed from a very manageable 42% of revenue to an astronomical 215%. Every single dollar made by launching rockets and selling satellite internet was being immediately drained to buy computing power. Management tried to pull off an aggressive maneuver to stabilize the ship. They tried to fast-track SpaceX directly into the S&P 500 index on day one. If they succeeded, index tracking funds and automatic retirement accounts would have been legally forced to buy the stock, automatically injecting $14 billion of passive capital into the company. But the S&P Index Committee stood firm. They have a strict rule. A company must show cumulative profitability over its last 4 consecutive quarters. Because the xAI merger saddled the balance sheet with billions in losses, SpaceX was rejected. The NASDAQ agreed to list them anyway, but the warning shot from Wall Street was clear. What makes this gamble so precarious is that Grok isn't even dominant in the AI race. Independent enterprise data shows Grok holding a meager 0.4% market share in the corporate sector, which is where the actual money is made. To make matters worse, the AI team has faced extreme internal instability. Out of the 11 original prominent co-founders who started xAI in 2023, every single one of them has left the company. To pump up revenue numbers just before the public IPO, they turned to complex corporate partnerships. They announced a massive deal where Google would lease compute power for $920 million a month. Sounds amazing, right? But if you read the regulatory footnotes, Google simultaneously owns a 6% equity stake in SpaceX, and either company can cancel the contract with just 90 days' notice. To seasoned market analysts, this looks less like organic demand and more like circular financing designed to paint a pretty picture for public investors. And the operational execution on the ground has been surprisingly messy. When building their primary ground-based supercomputing cluster, the engineering teams made a fundamental architectural error. They mixed three entirely different, incompatible generations of GPU hardware. In high-performance computing, a network only moves as fast as its slowest link. Because the architectures couldn't sync properly, top-tier multi-million-dollar chips were forced to sit idle, waiting for older chips to finish processing. The catastrophic result? The entire ground data center was found to be running at a dismal 11% of its actual capacity. With ground operations stalling, SpaceX is now doubling down on its most extreme sci-fi thesis yet, abandoning Earth entirely and building an AI data center cloud in outer space. They have officially filed paperwork with the FCC to launch an unprecedented computing network of up to 1 million satellites by 2028. To put that in perspective, Starlink is currently the largest satellite constellation in history, and it only has about 9,000 active satellites. SpaceX wants to scale that by more than 100 times. But this plan runs headfirst into the unyielding, brutal laws of physics. On Earth, data centers require millions of gallons of water and massive industrial fans to keep chips from melting. In the vacuum of space, there is no air and no water. The only way to get rid of heat is through thermal radiation, the slowest, most inefficient method of heat transfer in physics. Keeping enterprise-grade AI chips from cooking themselves in a vacuum is an engineering nightmare. Then there is the threat of deep space radiation. Without Earth's atmosphere to protect them, delicate silicon transistors are constantly bombarded by cosmic rays. This causes bit flips, where a digital 0 randomly flips to a 1 in the memory. In complex AI training, routine bit flips cause cascading computational errors, making the output completely unreliable. To protect against this, every single one of those 1 million satellites will need heavy radiation shielding, redundant backup computers, and massive thermal radiators. The weight and manufacturing costs will be astronomical. And finally, there's the software problem. The entire economic justification for a space data center relies on AI remaining centralized in massive external clouds. But software is evolving rapidly. LLMs are becoming highly compact, allowing advanced AI to run locally on your phone or laptop without needing an internet connection at all. If localized, on-device AI becomes the global standard, the foundational business model for a trillion-dollar orbital cloud completely evaporates. The ultimate tragedy here is that SpaceX never needed to take this gamble. It was already a magnificent, world-class aerospace pioneer. It had a highly profitable satellite network and an absolute unyielding monopoly on commercial space launch. In a normal financial world, SpaceX could have gone public on the pure merits of its rockets, dictating its own prices and guaranteeing predictable, massive profits for decades. But leadership caught the global AI contagion. To ride the wave of market hype, they tethered an American aerospace icon to a wildly volatile, cash-bleeding AI enterprise. SpaceX's rockets are still a triumph of human ingenuity. But by shifting 85% of its future value to the unpredictable economics of space-based compute, the company has traded a secure earthly monopoly for a high-stakes cosmic gamble. Only time will tell if this silicon Trojan horse will carry us to the stars or drag a legendary aerospace giant back down to Earth.